Good morning, folks. Hope everyone is having a good week so far. Certainly been an interesting several weeks, hasn't it? So this morning we're here to break down what we're seeing in order flow. We'll look at some of the big picture stuff as well. I welcome chart requests. Really, one of the big reasons I want to do this is to help folks learn more about my process, how I look at order flow, and examine potential opportunities in markets. And so we're kicking off this week's episode of Back to the Futures with me, Markets and Mayhem. It's Tuesday, March 18th, 2025. Where does the time go? So the folks at Bookmap would love for you to join their Discord. You can do so by visiting discord.com/invite/bookmap or use the QR code on screen. There's a regular rotation of educational events on there that are worth checking out to learn more about the platform. And to learn a little bit more about me, I'm dating myself here, but I have been active in financial markets for 20 years now, and it's been an amazing journey. One of the things about finance that you'll learn as you navigate through it, whether you're new to it or whether you've been at it for a while, is that there's always more to learn and that markets are always adapting and evolving and changing, and so too must we as traders. And I think that's one of the most rewarding and exciting parts of it is it keeps you on your toes. So if you're just getting into trading and you feel like you've mastered everything there is to know, I hate to break it to you, but the best part about this is actually that there's plenty more to know. There'll always be more to know. And as soon as we feel like we know everything there is to know in any area of life, we're generally doing ourselves an intellectual disservice. So keep your mind open. That's my big ask. As you learn more about trading, more about investing, more about all the other elements of finance, and really just as you navigate throughout your life, always keep an open mind. It'll help you to be ready to adapt as the world around you continues to change. So for me, I started working with Bookmap in early 2022. I co-founded TraderAid around that time, MacroVisor just about a year later. And my goal here is to share my experience. I was fortunate enough to have some great mentors when I was starting off as a trader. So I'm hoping to pay that forward and also share ideas on market opportunities because it's great to be able to identify what may move. It's even better to be able to understand why that process is in place, how we can build our own trades, whether it's on a day trading time frame or a swing trading time frame. I also build a number of tools, one of which you'll see in action today, possibly more depending on the tape, and I provide one-on-one coaching for traders and investors. Now, I frequently get asked, why do I watch order flow? Especially as someone who's more systematic in my approach to trading. And it's because I've been able to find a systematized approach to managing how I watch and implement order flow into my trades and into my analysis. So, first, let's break down a little bit about order flow. One of the big words you're going to hear a lot, whether it's today or when other people are talking about it, is deltas. And it's a very simple term, even though it might sound a little more complex. It's really just a difference. A delta is a difference. Most of the time, you're talking about the difference between buyers and sellers on the volume side of things. Sometimes you're talking about the difference in pricing. Sometimes you're talking about options deltas. So there's several different types of deltas. But for the context of today, we're really talking about the difference between buyers and sellers, whether it's those bubbles in Bookmap that you might see, which represent the difference between buying and selling volume at that particular moment in time, or whether it's the volume bars you might see on the bottom that are also similarly volume deltas, or whether it's the session volume profile, which shows you aggression on a certain side, right? Buyers or sellers at a particular price throughout the entire session's time frame. There's a number of different deltas that we'll examine as we go through the tape. Also like to look for large passive order flow or icebergs. Now, icebergs are not exactly what we may have had them described to us as. So icebergs are actually a very specific type of order. And it's designed to help the person placing the order reduce the size that's showing up to the broader market. So let's say I have 10,000 lots of ES to move. I might use a 500 lot 20 group iceberg, right? So basically, I've got to transact 20 times on those 500 lots. But the reason you might do that is, as you know, in Bookmap, if you saw 10,000 on offer, you'd freak out. What is that giant order sitting overhead? But if you kind of parceled out that order so that it was coming up in 500 icebergs here and there, people aren't really going to have a second glance at that, right? So it's really a, the goal of iceberging is to reduce the impact on markets, to also hide your size, so potentially you're able to get better filling. So it's not just a big part of the volume profile. That's a lot of inference if we're just looking at volume profile and saying, aha, that's an iceberg. If we don't know the order type, we're just inferring. The nice thing about Bookmap and looking at the MBO data package in particular from Rhythmic or Bookmap directly is you know exactly where there are icebergs and exactly where there are stops. And so there's no uncertainty, there's no guesswork. It's right there, it's systematized, and it's something that you can also tune your settings so you only see the most significant icebergs. So, so sorry for the brief interruption, just responding there. And so the other thing is exhaustive trading action. This is something that I think happens more regularly during a volatile tape. You have the temptation for one side to get offsides, and when they do, you can potentially have a reversal. Sometimes icebergs and stops will play a role in that. You might see an exhaustive amount of iceberg selling. At the same time, you have an exhaustive stop run on the buy side, and that can sometimes set you up for a reversal, moving away from that prevailing uptrend and reversing lower, right? So just some things to think about when we're looking at the tape. I also have built an exhaustion and absorption indicator, so we may be able to see that play out in a more programmatic way in terms of interpreting the tape as well. Now, why do I use Bookmap? Well, the biggest thing is the powerful visualization capabilities. I really like the diversity of data you're able to put onto a single screen. I also like how easy it is for me to layer on new features. I'm a programmer, so I like to be able to draw data from different sources and layer that in. That's one of those sort of living at the intersections of technology and finance assets that I'm able to lean into. And so I have a few things. I mentioned the exhaustion indicator, the absorption indicator. The other thing I built is the SPX options visualizer, and I'd be remiss not to mention that options are the market. We're watching futures, but largely what we're watching in futures are the impact of options on the futures market. And there's really no other way to cut it. Let's just break down the numbers. SPX options trade 1.2 trillion of notional every day. The ES contract, the E-mini futures contract for the S&P, trades about 300 to 400 billion of notional. So there's a massive difference between the options flow and ES, and largely what we're seeing in ES, about 75 to 80%, is that impact of dealers hedging out into ES, that exposure that the people they're selling to, their customers, are creating via options. So, for example, if I buy a ton of SPX calls, that market maker needs to go out and buy ES futures. It's liquidity positive to hedge out that delta if they are going to pay my calls back and my calls appreciate in value. Just like if I buy a ton of puts, that dealer has to go out and buy a short a bunch of ES, and then as those puts lose value, they're going to have to buy some of that back, right, in time, which is often what we see is there's a decent amount of volatility skew towards the put side on SPX. It's a hedging instrument. But at the end of the day, understanding options and the role they play is paramount to navigating this market. We can't ignore or discount that influence, because in doing so, we'd be doing ourselves a disservice as traders. Now, if you don't need to look at the options and you're trading just fine, fine. But if you want to evolve and grow and understand the regime shift that's happened in the markets over the last 3 years, you absolutely have to learn the impact that options have on the S&P and to a large extent, a lot of the more popular optionable stocks. So today's pivot will be ES 570375. These pivots are derived programmatically by looking at order flow, by looking at price action, and where these key actionable decision levels would exist. This is a pretty big level, too. If we're going back a fair amount, we can see the interaction we've had with this level on the June contract. And so far this morning, last I checked, we're trading above that level just by a little bit here. I am looking for that to be a bullish above, bearish below pivot. So right now, the way we're trading pre-market, let's watch how we open, but we could get some potentially decent long trades off of this level. If we do break below it, I will be looking for fades. Let's take a quick look at the options market here as well for SPX. And remember, SPX is the biggest options contract in the entire world. I talked about 1.2 trillion a day. 57% of that is zero DTEs. About 75% to 80% of the total volume is expiring in a week or less. So lots of short dated flow in SPX influencing the price in ES in undeniable ways, which is one reason we need to be cognizant. So if we look overhead, if we do get a decent bid into today's tape, we have this call wall sitting overhead at 57.37, which is SPX 56.80, right? We're calculating that price difference there, which is about 57 right now. So as we're trading the tape today, be aware that if we get a decent upward move, this positioning could absorb a chunk of that move. So that's something to just keep in the back of our head. All that call positioning overhead can be a bit like a ceiling. And finally, let's talk about some exclusive deals. You can get up to 20% off of Bookmap by visiting TraderAid.com/bookmap. So bookmark that for later. That's TraderAid.com/bookmap for 40% off. Scroll down to the special offers to find those deals. And you can also get 20% off of TraderAid.com if you're a new signing up member. Use the code Mayhem20 at checkout. That's Mayhem20 at checkout at TraderAid.com. So let's get right to it. We've got Bookmap on screen with the NASDAQ contract. And let's just zoom this out a little bit. We can look at the overnight session here. And Ships writes, "Hi teacher, I told a store owner that I chat weekly and to follow your show on YouTube on Tuesdays. He likes stocks too." And Ships, I imagine you're out there in Europe with the timing that you mentioned there because you mentioned 2 p.m. So very cool. Thank you so much for telling other people about this weekly event. That's awesome. So overnight on the NASDAQ, bit of a bump from the European Open, but now we've just been rolling over. And this trend microstructure looks like a bit of a downward trend in extending trading hours, just lower highs and lower lows. So something to take into consideration as we get into today's tape. Let's look at the ES contract as well. And I think I'm going to have to do a little bit of tweaking on these stops and icebergs and strength levels. Let me just take a look here real quick. So I don't really use strength much on here. There we go. So ES, kind of a similar look as NASDAQ, got that bit of a bump after the European Open, then rolling over from there and just getting to key 3 negative. So that's the third largest level of net put exposure on SPX converted to ES. And we may see a little bit of support. And then above, we can see that call wall I discussed during the slide deck. And overall, not a lot on this heat map. Now, remember, we are going through that contract roll, so that is going to have an impact on overall liquidity as well. And I'm just going to make sure that outside liquidity is marked on here. So right now, let's just unfilter this. Yeah, about 23,000 order book depth on S&P for the June contract. I imagine we go back to the March contract, it's a bit less than that, but you got to imagine that as well, this kind of makes a less liquid tape overall. So just something to be aware of. You've got OPEX week as a factor, which basically makes trading a bit more choppy. It reduces the probabilistic outcomes of some of the setups we may typically enjoy as traders. We also have Fed Day tomorrow. There's a fair amount of moving parts this week, so you could see some just-in-time hedging flows this morning and this afternoon as well ahead of the Fed. Today we got building permits and housing starts, which came in a bit mixed, but overall better than expected. All right, let's take a look at some of the other parts of the market here. We'll take a look at crude overnight. And we're also going to just quickly tick off strength on there. So crude, a bit of a flat move overall. Had a build overnight all the way up to, let's call it about 68.75, and then has been rolling over since then. You can see there is some liquidity overhead. I remember last night when I was doing some of the contract rolls on ES and NQ, I noticed there was this large offer overhead on crude around 72 as well. It has shrank a little bit into today's tape. I remember it being a bit larger last night, but still 90 on a contract where the depth is so low is something to be watching, to be aware of. And this one's going to roll over to CLK, so I'm just going to take care of that real quick. And so when you're doing your contract roll, one thing that's kind of cool that might help you out is if you've got chart settings that you want to make sure you kind of keep consistent, you can inherit them, right? And that makes it just a little bit easier. You still have to do a little bit of management. It doesn't inherit all the settings. So there's certain specific things you might need to check off or tweak or otherwise, but it at least makes it a little easier to do those contract rolls. Or if you're fancy and you want to do this offline, you can also create a Python script or just a sed script that goes through and updates all the futures symbols in your bookmap configuration file. So that's how I roll my equity futures contracts. Just go through and basically run a script that does a string swap. And that makes it a lot easier to do that roll. It keeps all your settings fully intact. And eventually, hopefully, we get a feature that you just press a button and it does the whole roll for you. But for now, I've got a script, and you can also use the technique that I just showed you. Now, for folks out there that want to tune up their bookmap to kind of get a similar view as to what I have on screen, I just want to quickly go through some things. We've got about 21 minutes before the market opens. So I know folks like to look at stops and icebergs if they have them on Bookmap, but sometimes they get a little bit overwhelmed with what all is being shown on screen. So I want to show just how I tune that up a little bit. So on screen, this is the stops and icebergs on chart plugin. And you'll note that I'm using a standard deviation multiplier of 10 and an interval period of 30. So basically, we're taking 30 minutes to get us kind of a sense as to what a large iceberg might look like. And then we're pushing up that standard deviation multiple to the highest level so that way only the most noteworthy icebergs are showing. And I do a very similar setting for my stops, 30 minutes, 10 standard deviation multiplier. And then I have just a few tweaks here. I have buys and sells color coded for the type of order it is. And all of that just helps because then on screen, you get a sense as to exactly what you're seeing, right? So give me 1 second. I'm just going to tweak something here. There we go. And this is the unfiltered view of ES, by the way. You can see that market maker liquidity bracket above and below. And this is the filtered view where you have that bracket largely filtered out. So there is a way that you can do that. I have it set up with TradeMap Pro. So essentially what that's doing is it's going through and using an algorithm to filter out that liquidity that I don't necessarily want to see. It's a algorithm called the bot remover. There's also TraderMap Lite. You can do the same thing with that, but it doesn't have as many contracts that it supports. It also doesn't convey that MBO data like the on chart stops and icebergs. But nevertheless, if you're trying to use Bookmap, but you're just a little leery of these bracketed market maker algos that kind of reduce some of the usefulness of the heat map, fear not, you can use TraderMap Pro or Lite to get rid of that and make that chart a lot more useful. So that's another thing that I think is super helpful if you're using Bookmap and you're trying to make sure you're really only seeing where there's signal and trying to avoid some of that noise. Let's take a look at Bitcoin real quick. I know there's a lot of folks out there watching it. I'm still a little leery of Bitcoin here. And look at that move overnight. You had the pump and the dump. Kind of nasty. I'm just going to bring up this longer term chart because I'm still of this view. This is a chart from TrendSpider showing Bitcoin. I'm still of this view that the path of least resistance for now is likely to be lower. It doesn't have to be, obviously. We're in this low volume node. Buyers could very quickly pull us back up into the supply zone. So that's the bull scenario. You get this quick pull higher. But the bear scenario is you get pulled down into the demand zone, which would match the prevailing short-term trend, right? We do have bidders that continue to come in the high 70s and try to pull Bitcoin higher out of that demand zone. So far, buyers are defending price around this area, but there's also just not enough transactional activity here for me to be terribly confident that they're going to prevail. So for Bitcoin, I'm still looking at this as potentially trending lower, getting back into this larger demand zone, and then resuming the uptrend. And folks, if you have chart requests, things you want me to take a look at, let me know. More than happy to pop that on screen and have a look. Let's take a look at some of the Mag 7 stocks ahead of the open here. Got Apple pretty much flat. Not really a lot going on with Apple overnight. Amazon, bit of a drop this morning on Amazon. Lots of demand lower, but overall a supply heavy order book. But yeah, that was a bit of a chunky drop this morning. So that portends to Amazon stock opening down about 1.4% here in just about 6 minutes. Got Broadcom. Got to follow that one now. It's sort of one of the, was a stealth AI play for a minute. Now I think it's got everyone's attention. We're just going to pull this back to a 12-hour. So a bit of a similar look as Apple. Really not a lot going on with Broadcom overnight. Google, similar look, or Alphabet for the 5 people on Earth that call this company by that name. But it is a little bit supply heavy on the order book, and we've got a lot of demand right lower. This is going to be a very interesting open today. We've got all this liquidity stacked below, but overall, most of these order books are supply heavy, meaning there's still a fair amount of sellers overhead. Meta, a bit of a drop. Let's see where it was overnight. Yeah, it's just been sort of selling throughout the pre-market session here. Now trading below $600 a share on Mark Zuckerberg's Meta, down about 1% pre-market. And there's MicroStrategy. I kind of have this thing up here for the lulls, really. And this thing is just a a bit of a garbage fire, if we're being completely honest. I know some folks feel like the only way to get exposure to Bitcoin is through something like this. I would be very careful. It's back up to the EMA 21, the weekly, challenging it from below. If buyers are able to make a push there, we could get back into the supply zone, this chunky supply zone from like 320 to 400. But I would be cautious here. I do think the prevailing risk off atmosphere is going to continue to undermine this stock. I've got some requests here. I've got Meta, which we just did, but I'll zoom out for the long-term chart, in Tesla. Meta looking a little bit precarious on that long-term chart. Remember, we talked about really needs to stay above that 21-week EMA. We're not seeing that as much here, so I'd really like to see buyers pull it back above to get a bullish look. We can see the MACD histogram rolling over on this, showing negative momentum is really starting to become a little bit more prevalent. Let me just take a look at the option structure on Meta real quick. Yeah, so you do have a decent amount of put-driven support down at 595. So I'd be watching that and 590 on Meta as potential areas where you could get a balance. If it continues lower, 595 and 590 are put-driven levels of potential support. So just pulling that on screen so you can see real quick. There's that 590. There's that 595. And then overhead, you've got 600 and 625 is the largest areas of call-driven resistance on Meta. So for now, Meta really needs to get back above that EMA 21 on the weekly. Otherwise, I feel like it's more precarious. We could see the last times it challenged it, it gets a lot more volatile. Ultimately, it did resolve higher. We'll see if this time is like those other times. But the other problem with Meta that I have is the AI narrative is challenged. They've poured an enormous amount of CapEx into AI, and there's really not a lot to show for it of yet. And their crown jewel, the Llama models, are underperforming just about all the newer models that have come out. So now we're waiting for Llama 4, which is supposed to be a new model that'll be a leadership model. And if they're not able to demonstrate that they're still in that leadership point, and models from Alibaba and Baidu and DeepSeek and OpenAI and some of these others continue to outperform, that's going to be a big problem for Meta, who has some of the most aggressive AI CapEx plans. So I feel like some of the narrative here is challenged for what drove the stock so much higher from its lows. Let's take a look at Tesla here. Yikes. So it's back in its big fat demand zone, which makes sense. We had this enormous move higher off of what exactly? What really drove that move? It was basically the presumption that because Trump won the presidency, that's somehow extraordinarily bullish for Tesla, which, if we're being completely sober about our analysis, it's really not. In some ways, it may even be bearish when we have a lot of policies coming off that we're supporting EVs and renewable energy and this, that, and the other. But you also have a CEO who's done everything in his power to alienate the core customer base of Tesla, who tend to be a little bit more left-leaning on the political spectrum. So you're seeing global sales collapse. And JP Morgan just put out a note, and let me see if I can get the exact note. It's a pretty interesting note. I'm just going to read it verbatim, and then I've got a couple other questions I'll go through. Okay. JP Morgan expects Tesla to report its worst quarterly deliveries in 3 years. And they go on to say, quote, "We struggle to think of anything analogous in the history of the automotive industry in which a brand has lost so much value so quickly." That's pretty incredible. I can't say I'm super bullish on Tesla. I think it could get a pop. I think it could get a trade because it is becoming a bit, exhaustive on the selling. Let me just take a look at the option structure on Tesla. I want to see something real quick to see if there really is this sort of put skew developing on the stock. Yeah, so there's very bearish skew on Tesla right now. That would be the biggest reason that I would be hesitant to fade it from here. It's because everyone else is sort of in that trade, and when everyone's on the same side of the trade, that trade typically is crowded and doesn't necessarily have the same amount of momentum. So that doesn't mean Tesla can't go lower, but it does mean there's a lot of people already positioned for that. So I'm just going to bring this up. This is a chart of skew on Tesla. You can see that skew is bearish. It's come off of the extremes that we've seen that have previously marked an interim bottom in the stock, but it's still quite bearish. So that would limit my willingness to want to bet against the company here just because it's already a crowded trade. I think you could start to potentially get a pop, but right now momentum still points lower even this morning. Momentum in Tesla is looking pretty nasty. Let's see. Tesla shares marked to open. Actually, now we're open, right? We're just been open for about a minute. Tesla shares down about 3.75% in today's tape. So let's get to Tesla on Bookmap here real quick. And you can see now that we're open, there's all that liquidity across the book. Relatively supply heavy, 1.1 million delta to the supply side on Tesla. So again, I would be somewhat careful with this one. I think that it's very put heavy, so you could get a bit of a pop, but the prevailing downtrend and the core rot in the fundamentals of this company make it kind of uninvestable here. It's basically just a trading vehicle at this point, and it's still wildly expensive versus its fundamentals. So hopefully that helps, Ships. Let me know. Street Salsa, good morning to you. Thanks for tuning in. And then I've got a question here. Could you please speak more to on your tech experience overall? What skills help you to be a better trader? Sure. You can see a little bit of a pop on Tesla happening there. We're just going to move this over to ES as I get ready to ramble about my sort of blended background. So I've been involved with tech for a while, and that's given me skills that make me, I think, a little bit more from an analytical perspective, a more data driven perspective when I lean into those skills, because in tech, you don't really have a lot of room for error. You're either right or wrong on a lot of things. And so that sort of mindset gave me the opportunity to apply some of that to markets. And for me, I'll tell you a couple things. So first, the big thing that I see a lot of folks that I coach in trading struggle with is preserving mental capital and time. It's not just the amount of money we have in our portfolio. It's also our mental capital. It's also our time that really matters. And I feel like a lot of folks get exhausted because they're just staring at the screen all day looking for an opportunity. They may even miss it because they're exhausted by the time it hits the tape. And so the way that I look at trading is it's really important to preserve your mental capital and your time such that I try to systematize and automate as much of my analytical process as I can. So I built tools that help to show me where there are key actionable levels based on order flow, based on price action, based on options flow and positioning. That's one area that allows me to save a lot of time. And then others, just I built a Discord bot and a number of back testing platforms in Python and otherwise that, again, help me to save a lot of time and systematize and automate my approach to identifying where there might be actionable trading signals, where there might be swings that I want to take on or day trading opportunities. And in doing so, I save a lot of time. For example, when something noteworthy happens in Bookmap, typically I have an audio alert that fires off that basically says, hey, look at the screen. Something interesting is happening here. There might be a trade. And that's for absorption events, exhaustion events. It's for really large iceberg or stop runs. It's even for unusually large trades. And so that's just one example, right? I also have my news feeds where the squawk guy will come on when there's something important that I need to pay attention to. So those are just examples of sort of preserving mental capital rather than constantly poring over the news or constantly watching charts. I have some shortcuts that help me preserve some of that mental capital by leaning into tech to generate alerts, by leaning into tech to find actionable levels and setups. And I think that that's an advantage that everyone who has that background should consider leaning into. And if you don't have that background, consider polishing up your tech skills because everything's basically driven by technology indirectly or directly. And the more we can use technology to improve the outcomes for the amount of time we invest in markets, the better off we'll be in preventing that burnout and eventually achieving consistency and success as a trader. By the way, we do have a bit of a sell happening here. I'm just going to get back into the markets. And one thing that might be causing a little bit of anxiety this morning, the Trump team explored a simplified plan for reciprocal tariffs. U.S. officials have recently weighed whether to simplify the task of devising new tariff rates for hundreds of U.S. trading partners by instead sorting nations into one of three tariff tiers. So, again, the market had a nice day yesterday because we weren't hearing all this nonsense about tariff this, tariff that. And you can tell the market wants to rally. But every time this policy uncertainty hits the wires, it falls over. So we're below that pivot we talked about earlier. And we can see that we just have some motivated selling coming into the tape this AM. There are some attempts by buyers to absorb the selling pressure. We saw 1,007 contracts thrown at that last little swoon lower. But so far, sellers seem to be enjoying the upper hand. And it's interesting because this is options expiration week. You know, we have the futures expiration and options expiration on Friday, and there are those passive flows bidding up the market, particularly first and last hour, but it's being more than offset by some of this angst about trade and likely, as I mentioned a little earlier, some of those just-in-time hedging flows ahead of the Fed. So if you don't know what just-in-time hedging is, I'll break it down. You have a market where a lot of folks are selling volatility. What that means is if you're buying puts well ahead of an event, you're losing the value of that option. That premium is being worn down by option sellers. So the way that a lot of hedgers work around that is they hedge right ahead of the event. So basically, like, just about 36 hours, 24 hours, 12 hours, whatever, you'll see this beginning of day, end of day, just in time hedging. And the Fed tomorrow is kind of a big deal event. So some of this pressure this morning may also be those options flows hedging the Fed tomorrow. And it's a big day. It's not just the Fed rate decision. It's also the summary of economic projections, which means they're going to come out with their view on inflation, employment, the economy, and rates. So it's not just a rate decision day. This is one of those big Fed days that happens 4 times a year. The last one is in December, and that was a big vol catalyst. You're welcome. Good morning. Good morning out there in 1985. Silver. I've got a request for silver. I am structurally quite bullish on silver overall. It's been a laggard, but it's catching up here. We're just going to use SLV, and you can see this is a pretty strong uptrend. You've got higher lows, you've got higher highs. We just want to see this next ramp here make a higher high. Personally, thinking we could get all the way to $40 an ounce on silver, which would be about 37 on SLV. And the primary driver here would be China and their stimulus domestically. So China, as a country, consumes about 15% of global silver. That's just number 2 to the United States. And a lot of that Chinese silver consumption can kick back online with enough stimulus to build the economy back, as well as infrastructure projects, particularly in renewables where silver is heavily used, as well as communications, military projects, and otherwise. I think silver has some room to really catch up to gold's rally. Now, the big, I would say, left tail risk to that is if you have a more pronounced economic slowdown globally, that can take the wind out of the sails of the industrial side of silver. We know the precious metal side of silver still has plenty of demand here. It's sometimes called poor man's gold or the devil's metal, as it often enjoys a rally alongside gold. But one thing silver needs that it hadn't had as much of until recently was industrial demand. Now we're starting to see that kick back up. So that makes me much more bullish on silver overall. That was the big catalyst, if you followed me on Twitter for a bit, that I've been looking for, is to see China's stimulus kick up, and particularly domestic stimulus that could bring about more industrial demand. So we're there. We're trading around $3,000 gold. If you'll recall, I was looking for $3,000 gold in the first half of this year, all the way back in August, September of 2024, right? That was when we hit $2,600 gold, which was what I was looking for back in the first quarter of 2024. So we've been kind of heading down that precious metals trajectory that I've been looking for. I've been trading this stuff for pretty much the whole time I've been trading. So it's very intimately familiar, gold and silver. Those are two markets that I track pretty closely. The other thing that I want to say out there for folks that are in gold and silver that are watching these markets, please be careful about the miners. There's a ton of terrible miners and there's a few good ones. A lot of the management out there is terrible, which is why they chronically underperform gold. And you've got folks that try to sell you on buying these miners that often are being paid by the miners to promote their stocks. If you've got folks out there that are constantly promoting gold miners and, talking their book essentially, or being paid to promote that stuff, their interests are not aligned with yours. Personally, I've always found it easier to play gold and silver than the underlying stocks, but there are occasionally plays that I'll talk about, particularly on the Trader Aid Discord, where you may be able to get a little bit of outsized leverage using the higher quality, better managed miners in the space. So S&P futures continuing that stair step lower, decent amount of selling pressure lower. Just seeing a bit of a bid here. We got a stop run. We've had two absorption events here as well. Just had a chart request. Looks like AG. I think that's First Majestic. Yeah, so this is an interesting company. I've actually met the CEO of the company at a gold and silver conference. He seems like he's a well-intentioned guy. He's not like some of the management that I've seen in the space that just seem intent on, taking shareholder money and setting it on fire so they can party, which honestly happens a lot more in the gold and silver space than you might want to believe. So I think First Majestic is decent. I was kind of disappointed with some of the acquisitions that have happened in the space. I think Silvercrest got bought out by one of the other miners that I'm not a huge fan of. So that was one of the miners I actually liked. It was, Core, symbol CDE, bought Silvercrest. Not a huge fan of CDE or that acquisition, just because the balance sheet at CDE is a hot mess. So you might get more chronic underperformance from that. But AG, let's just dive into the fundamentals real quick on this one. Yeah, so I don't care too much for the fundamentals of First Majestic. It seems objectively expensive and they have a negative profit margin. So, it's just kind of going the wrong way for what I like to see. Let me just take a look at one other thing that I like to look at in terms of their free cash flow. So they do have free cash flow. That's good. They also have a pretty chunky pile of debt. So I wouldn't say that First Majestic would be high on my list here. I'd rather own silver outright than First Majestic here. Now, if they execute well, they've got the leverage that they could outperform silver, but that's the key question, particularly for a company that has a negative profit margin, negative 18%, negative 7.5% return on equity, negative 100 million net income a year. There are some things here that are red flags I'm just not a huge fan of seeing. I got a question. Do I believe in the movie Wolf on Wall Street? I mean, in the sense of that's how the industry functions. So those were the boiler rooms back in like the 80s that were doing all that high pressure stock selling. That doesn't really exist the same in that form today. But there are analogs, right? So there are social media promoters and mailing list promoters of stocks that get paid. A lot of that stuff is questionable in terms of its legality. And that's something you'll see a lot in the microcap stocks. You'll see it in some of the, commodity stocks, resource stocks. You got to be careful when you see people adamantly pumping this stuff as to whether they have a financial interest in it, whether they're either talking their book or being paid to promote that stuff. So is Wolf of Wall Street exactly an analog for what you're seeing today? No, but it is similar. Just like you do have, if you read that sort of quasi biography of Jesse Livermore, Reminiscences of a Stock Operator, remember the bucket shops that are mentioned in that book? And by the way, if you haven't read Reminiscences of a Stock Operator, read it at least twice, if not 3 times. It's free. You can download it at this point. The copyright's no longer in effect, so you can read it for free. But the bucket shops back then, those are the prop trading firms of today. It's the same thing. And they rely on the premise of people blowing up their accounts so they can pay out the few people that win. Though that whole industry is super duper shady. So, do we have analogs of Wolf of Wall Street and other things like that? Absolutely. There's still shady business going on in the world of finance. There's still people that are pumping stocks that are getting either financially incentivized to do it or talking their book or, otherwise. That sort of stuff goes on a lot. There's also a lot of, just sort of disingenuousness about how people might represent the skills they want you to believe that they have versus what they actually have, right? There might be a big gap. Sort of fake it till you make it mentality is big in finance. It's also very big in AI right now. So that's my super cynical take. Hopefully that's helpful, but I do want to at least do my best to try to answer your questions honestly. So we're going to go back to the charts here. We still have the S&P just falling out of bed. The next pivot level to watch here, 5670.25. That's a major pivot to watch. 5670.25. It's about 6 handles above it right now. Cutting lower in this tape. Let's see if we're starting to get any of that options flow in yet. Not yet. Probably the next couple minutes we'll see some of those prevailing flows. That put wall just down below here should also provide us some support. That's at about S&P 5600 on SPX cash index, right? So we're converting that to the ES June contract level when we see it on here. I would imagine that should be a formidable level of support if we don't get some support at the 5670.25 pivot. We also see some of that flow coming in now. Actually, the call is getting the most activity right now, the hottest call in the tape. But this is early on. We'll see how that flow evolves. That's from the SPX Options Visualizer. You can learn more about that by visiting traderay.com/SPX. Basically, the idea is taking the options flow in the SPX, converting it to ES levels, and labeling it based off of its importance and how the market might interact with it. Oh, and yeah, someone mentioned crypto in the chat. There's all kinds of funny business in crypto. Don't even get me started because it's so loosely regulated. You can get away with all kinds of shenanigans out there. It's basically the Wild West. So be super duper careful about risk taking in that space because there are a lot of bad actors there. There are good people there too. Don't get me wrong. Like in every space, there's good and bad. It's not like it's just universally bad people in one space or another. But in crypto, because of the lack of regulation and what you can get away with, it's attracted a lot of really seedy elements. So you just got to be cognizant of that when you're taking risk. Let's take a look at the NASDAQ and some of the NASDAQ stocks here. NASDAQ just getting absolutely pummeled here. We're going to zoom in just a wee bit. So you can see we had a bit of a seller exhaustion here. That's what these, this row or a column, I should say, of these red circles are. It's about 393 contracts in that seller exhaustion event. So you can see we're consolidating a little bit after that exhaustion was identified because sellers are getting just a little bit ahead of themselves on that. Let's take a look at some of the larger stocks out there as well. And we're going to zoom out just a little bit. So Apple kind of holding its own, really just going sideways. Amazon, though, we had a bit of a clue this morning. We saw that drop pre-market. We're continuing some of that order flow. Just seeing prevailing selling pressure on the tape. And again, a supply heavy order book with a delta of 1.5 million favoring that supply side. Let's look at Broadcom here, pretty much just going sideways. Also a bit of a supply heavy order book with a delta of 1 million on the offer side. Alphabet, Google, whatever you want to call this one, it is looking heavy this morning, getting just a little bit of a pop off the open and then just selling. Remember we talked about that downwardly trending microstructure? This fits it to a T. Lower highs, lower lows, lower highs, lower lows. Finally seeing some buyer absorption down here. That's what this indicates. You had a buyer absorption event of about 19,435 contracts. But we're still moving lower, and we're still in a somewhat offer heavy order book with a delta of 328,000 on offers versus bids. Metastock also selling off the open. We talked about that one a little bit, and it's actually cutting through that 590 level of implied put support as well. So looking just a little bit more bearish on Metastock. And it also has that sort of microstructure of lower highs and lower lows, though right now it's consolidating, and there's a large bid, just about 585, 13,000 on bid there, offering a little bit of support so far. MicroStrategy also selling a bit off the open and now consolidating. Microsoft, not to be confused with MicroStrategy, I believe they renamed the company Strategy now, which I don't have any positive comments about it. But that sell down in Microsoft definitely has some legs here. This is a company that's struggling a little bit in its execution. Their CEO being quite a bit more honest than some of the other CEOs in the Mag 7 space, basically saying we haven't had that AI super app moment like, what we saw back in the day with Excel or email or other things that changed the internet. AI hasn't had that moment. And Satya Nadella, the CEO of Microsoft, was pretty transparent about that. But we're also seeing signs that really Microsoft's endeavors into AI aren't necessarily paying off. I still am of the view that CapEx for AI data center spend comes down this year from the projections we've had. I just can't see a world where, with the amount of efficiency improvements we've made, that hardware spend makes sense. So that is a bit of a net negative for the next one we're about to bring up. That's NVIDIA. NVIDIA also selling off in this tape here, seeing some aggressive attempts at buyer absorption, but so far still getting to new lows in a very heavy order book, a delta of 21 million to the sell side. 10 million on bid, 32 million on offer with NVIDIA. So again, this is one of those days where the prevailing AI narrative is something that is being challenged. You can see it in the tape. You can see it in that continued rotation away from tech and into other parts of the market. High beta is being sold, low vols being bought, market cap weights being sold, equal weights being bought. These are trends I've been talking about that I thought could take shape since January, and they are, and I believe they're still in their earlier stages. And then back to Tesla. Tesla rolling over here. We talked about it a little bit pre-market that it was getting a little heavy on the skew side, but also I didn't have any real sense that this was going to bounce quite yet. We are selling off to new lows on Tesla, down to 223, 275. The biggest, chunkiest offer to look at on this one that I see near us is $220 a share, which is about 250,000 shares on bid. On bid, I should say. And this is another book that is a little bit offer heavy, 1.1 million delta on Tesla. Let's check on gold. Wow, look at gold trading $3,043 an ounce. Epic moves in gold over these past several months. I mean, this has just been an absolute beast. And the funny thing about it is we've seen so many things that typically wouldn't necessarily be bullish for gold, and gold is just looking the other way. When rates were on the rise, gold was still moving higher. When the dollar was moving higher, gold was still moving higher. When stocks were moving higher, which is typically somewhat bearish for gold because people take money out of gold to buy more stocks, gold was still moving higher. And now that you're seeing the rates come down, the dollar come down, stocks come down, gold's still moving higher. There is a persistent bid. And I'm going to just quickly tell you why, in my view. Gold is a hedge against uncertainty. It is not a hedge against inflation the way people have talked about. It doesn't really perform as well in that capacity as one would hope. But it is a hedge against uncertainty. And we have really high levels of uncertainty: geopolitical uncertainty, economic uncertainty, domestic policy uncertainty, you name it, uncertainty all over the board. That is fuel for gold. Now, are we getting a little bit lopsided on the long side? For sure. Are we getting a little bit, excited? Maybe we'll have to consolidate a bit. Yeah, it's quite possible. It's going to be very interesting to see how gold reacts to the Fed, because another area, gold typically doesn't do well on Fed week. Try telling gold that right now. It doesn't care. There is a big invisible hand just accumulating gold. And that's one reason I'm bullish on silver as well, because typically they move in tandem, and silver's industrial demand is coming up. So I do think this is a really interesting area. And again, be careful of the miners, because they're very few and far between are there miners that are really well run and will outperform gold consistently. So do your homework. Don't just blindly buy them because someone who seems smart is recommending them. Make sure you understand exactly what you're buying and why you're buying it, and how you qualify that thesis, so that you know if the thesis isn't working out, it's time to get out. And if you know if the thesis is working, which areas to watch. For example, if you're buying a gold miner and you don't know what it costs them to produce an ounce of gold, you don't know that miner. If you don't know how much debt they have, if they're profitable enough yet, you don't know that miner. If you don't know how much proven reserves versus reserves they think they might have coming up, you don't know that miner. Understanding how the company operates is critical to understanding whether you're buying trash or treasure in this space. And if you don't want to dive in that much, look at the metal itself. There's plenty of ways to, trade or buy gold. You can even look at physical gold. But at this particular price, I'd be a little bit cautious because of the extent of the move we've had and how lopsided the trade has become. We're already above the price target I had for the first half of 2025, which was 3,000. Let's check back in on the S&P futures here. And still moving lower. We are testing that pivot, 5670.25. Looks like we're going to grind through it here. The next level to watch really closely is going to be moving lower, that put wall, which is now, by the way, where the most active put strike is. We can see that on the options chain. The most active put strike is at SPX 5600, which has confluence with the vol trigger and the put wall. Means it's getting quite likely that the magnetic force of that strike pulls us lower. Again, knowing options positioning, understanding the flow and the impact it has, and realizing full well that this is the biggest source of price discovery in the futures. That's right. SPX options and the hedging impact of dealers in the futures contract is the biggest source of price discovery, hands down. No competition even close to that. Why does that matter? Because that's why it is imperative for us as traders to pay attention to options and the influence they have. I know there are naysayers about this, but the math is certain. So the footprint we see in the S&P 500 futures contract is largely from market makers hedging out delta in the positioning that's being taken on by their clients. Once you realize that, what you really realize is, to some degree, that's like Plato's cave. If you're not familiar with it, look it up after this, but basically you're just seeing a shadow of the big picture. So don't be shy. Look at the SPX options complex for clues as well. It's always providing some degree of signal. So I would not be too surprised if this flow continues like this, that we get pulled lower. I'd like to see the midpoint disappear, because the midpoint shows us that flows are somewhat balanced between the two most active calls and puts. But overall, there is this stronger magnetic pull lower. And if we look at the volume right now, there's a 27% excess of put demand versus call demand in SPX. That's another sign of that just-in-time hedging I was speaking to earlier. This idea that you're going to have hedging that happens right ahead of the event volatility catalyst, in this case, the Fed, their rate decision press conference and SEP, or summary of economic projections, where they'll talk about what their view is on the economy, on labor, on inflation, and where rates are going. That's a big event volatility catalyst. You remember how volatile the December Fed meeting was? That's the last time we got one of these reports. So again, that just-in-time hedging, pulling liquidity out of the market because folks are buying puts to hedge that event. And that means that when they're buying those puts, market makers are having to sell S&P futures short. That pulls liquidity out. That leads to some of this price action that we're experiencing. So, folks, I want to thank you for tuning in to this episode of Back to the Futures with me, Markets and Mayhem. I'll be back next week, Tuesday at 9 a.m. Eastern. My 3 bits of closing wisdom: if you don't know the setup, don't trade it. This is a tape that's much less certain with options expiration week, especially. If you're going to trade, use smaller size and wider stops so you don't get blown out. If you want to learn more about what I'm doing at TraderAid, visit TraderAid.com. You can use the code Mayhem20 at checkout for up to 20% off. If you want to check out Bookmap, visit TraderAid.com/bookmap. Scroll down to the special offers and get up to 40% off. Thanks for tuning in, everyone. I'll catch you next week. Oh, by the way, I'll also be around tomorrow for FedNest Day. So tune into the live stream for FedNest Day as well. Thanks, everyone. Catch you soon.